Okay, I think we've got time for one more question. Is Alfie Best here?
He's not.
Alfie Best is not here. Okay, so I will ask the Alfie Best question, which is, how will the rise in interest rates affect recovery and banks' repossessions? Presumably one will go down and one will go up, but maybe there's a bit more to it than that. Simon, I mean, as they're talking about repossessions, perhaps you could give your professional view on such awkward matters.
Well, I shall wear two hats in answering this question. One is as a property manager, and I've mentioned that we look after properties and we collect rents from 5,000 tenancies across the UK. And the other is as a property receiver. Collecting rents, first of all, as a property manager, collecting rents is never a straightforward affair, and in a recession it's even more difficult. When interest rates inevitably start to rise, those companies that have been holding on by the skin of their teeth will find it even more difficult. And forget property for a minute, when interest rates start to rise, business failure will start to rise significantly. And that will mean more empty shops, more empty factories and offices and so forth. So I think that provided we don't have a spike in interest rates like we saw in 88 to 90, we should see and manage a situation that can be managed, and we'll see business failure but people coming into the marketplace to fill that vacuum. In terms of property and repossessions, well, I think we all know the answer to that, and I can't remember which one of my panel members mentioned, I think it was Andy actually, about when interest rates start to rise, can you afford to repay your loan? And the answer is most people out there can't. And I think, and Andy quite rightly said that the banks could have pulled the rugs from under the feet of more people, and they have been tempered and haven't pulled the rug in terms of as much as they could have. So I'll give you an example. If 4 or 5 years ago, we have 4 or 5 receivers within the firm. We've got the longest serving receiver in the UK working for Australians, and we thought that receiverships were going to come flooding in. We'll get lots of repossessions. We could put them in our auction, and hey presto, through the recession, our auction house would be very, very busy. Actually, whilst we've had some repossessions, we haven't had many at all. And at the moment, we have 10 or 12 appointments on our books as receivers. Now, we don't do the volume receivership work that some of the larger organisations do, but there certainly hasn't been the floodgates that you might have expected. But when interest rates start to rise, I think that the banks will start to lose their patience a little bit more. There'll be a lot of pressure, and I think we'll see far more repossessions. So I don't want to take up too much time.
Okay, Mike, do you want to?
Yeah, well, first of all, I think the point made about the speed of the interest rate rise and the way it's managed is probably the most important of all. And obviously, because of the work we do, we have to watch this very closely. And so, I don't know if anybody that looks at their portfolios will undoubtedly remember as spring came into summer this year, there was quite a lot of chatter in the US about the way they start pegging back on QE. And the immediate impact was bond markets took a hammering, stock markets took a double hammering. But the interesting thing is those markets have recovered. And the amazing thing is that the one market that has really been impacted, and in fact it actually allows us to see what will happen already, is the mortgage market in the United States, because long-term debt financing in the United States has gone through the roof. So in the space of 3 months, the cost of a long-term mortgage in the US, which is typically 30 years, is now 30% more than it was 3 months ago. And that's solely because people think that QE is going to be slowed down. And sure enough, if you look at the impact in June and July, new house purchases or second home and second-hand purchases, they call it over there, on properties are down 13%. So people don't think they can afford, so they pull back. And then if you take that onto the repossession market in the UK, I think there's no doubt about it. If it weren't for the fact that interest rates have been kept artificially low, repossessions would be through the roof. Council of Mortgage Lenders keeps overshooting on its predictions of repossessions, and that's because it didn't expect, I think, interest rates to be so low for so long. But what I would throw in on residential property is really a slightly different issue, which I think is probably the next big thing on the horizon. And that is, firstly, the fact that the government, in its decision to start underwriting people's mortgages, which is exactly what the Americans are trying to not do, they're trying to walk away from Fannie Mae and Freddie Mac. In doing so, they're creating another bubble, and I think that bubble is going to burst with horrible consequences if we're not careful. And then the second thing, which the FSA, bless them, when they were still the FSA, pointed out, is the fact we've got 2.6 million people walking around with interest-only mortgages, and they reckon that 10% of those people have got some type of repayment plan in force. Even if those repayment plans don't work, there's only 10%. And so, if you look at the residential property market, sure enough, interest rates, I think, will remain low for a period of time. But in many respects, we are just building up momentum for the next big problem.
Well, there's a gloomy prediction. Andrew, can you give us
It's quite interesting because you got
something brighter?
Yeah, well, you got 2016, so you got 3 years to do. You got 3 years to do something about it, haven't you? Yeah. But
3 years to pay off your mortgage.
But actually, it's not going to go up from 0.5% to 5% overnight, is it either? No. It'll go in small little chunks.
0.5% to 1% is double.
Yeah. You're right. But our mortgage has got behaviours. The HSBC, and I'm in commercial banking, but I asked about that. Our personal mortgage book has been paid off quicker than ever. So the other side of it, a lot of Joe Public have been very sensible and actually left their payments as they are and paid down their debt, which is what the government wanted us to do in the first place. In fact, I'm seeing it in the commercial arena too. By the way, that's because our HSBC, we're quite a prudent bank, so the type of funding we did are quite low loan to values. I believe maybe we took far less risks than the other banks, but the mortgage book is being paid off at a big rate. So.
Okay, well, that's interesting stuff. I think that's enough.
Someone's going to ask us a curveball now. Yeah.
Sorry, just one extra question on the mortgage, on the personal mortgage market, because obviously most businesses, their interest bill isn't huge compared to their wages bill and they're all their other bills. But at the personal level, most people's mortgages are quite large. Do I understand correctly that there's an upcoming change in the mortgage lending rules that's going to really restrict people if they need to roll over interest-only mortgages?
Right, so there's the question. Is there an upcoming change in the mortgage rules which will stymie people who are having to roll over their fixed-term mortgages? We were looking at Andrew, and he's shrugging.
I don't know. I know there are rumours around it's going to be the interest-only mortgage might be the next big mis-selling scandal. So,
Simon,
and it's not my reading. It's only because what I read in the press.
The FCA issued guidance about a week ago, Graham, saying what they are hoping lenders will do in the future. But in reality, it still doesn't solve the problem.
No.
You've got a load of people walking around who, if they need to remortgage, are going to find that perhaps they're not going to be able to remortgage on an interest-only basis.
So I thought the FCA guidance was coming in a slightly harder format that would almost prevent banks from doing interest only going forward.
It kind of tries to paint an outline when they will allow them to do it and won't allow them to do it. And believe me, they are still doing it. They are still offering it.
10,000 mortgage products in the market now at the moment. It's gone up to, from 3,000 to 10,000 in the last year.
I think the point is, as it was explained to me, it comes back to how are you going to repay that debt?
Yeah.
There's a lot of overexposure.
Yeah.
Right, well, thank you, Graham, for that. We started late, we're finishing, we've caught up a little bit, so my final act really is to thank you for listening, thank you for your questions, thank you for your interest, and thank you especially to the panel members for sharing their wisdom with us all. So thank you, everybody. Lots of thanks. And the buffet is...